to FEI, so we're really excited to have him back. They're always engaging and timely presentations. So for those that you haven't heard Stu before, Stu has been quoted in the Wall Street Journal, the New York Times, Barron's, guests on CNBC, all those impressive media outlets that Stu has shared his insights over the years. So again, it's our pleasure to have Stu present today. So Stu, you want to get started?
I sure do. Well, nice to see some of you and wish I could be with all of you. Dan, thank you very much for the introduction and for setting this up. Yeah, we calculated this is number 11 and glad to be there. You always have a great group. I remember lots of our times when we were together and lots of good questions. So I'm still looking forward to that as well. So what I'd like to do is Ashley is going to share her screen, which has my PowerPoint presentation. We'll go through that and, that should take maybe up to about 30 minutes. There it is. Hopefully you're seeing it at most. And then we'll open it up to the Q&A. And as Dan said, he's going to moderate that. I welcome your questions. I wish you all a happy new year, hopefully a healthy new year as we go through another variant. And I think we'll, at least from the economy's point of view, persevere. As you can see from my title page, we're looking for continued solid expansion for the U.S. economy. And this year, and the one can reasonably foresee in the next year, that as well. We think a lot of positive things are in place with obviously caveat of the course of the virus affecting us. But actually, if you go to the first page, so this is sort of a summary, a high summary of our forecast. Most of my charts following this there won't be tables, there'll be pretty pictures of numbers. And as you know, I've shared these in the past, but call your attention, of course, to the big bolded point at the bottom that this forecast, as any forecast, and has been and will continue to depend on a number of factors, a lot of which include the vaccination, the rise of Omicron, the possibility of another Greek letter variant out there, how consumers will respond to that in terms of resuming what we're calling normal activities. We are benefiting from the fiscal stimulus package that was passed, the infrastructure bill. And of course, we have not built in to this forecast the Build Back Better package. Don't know if that'll be passed or not. I mean, maybe pieces of it will be that Manchin might favor. So I say the possible package, but I'm giving to you a forecast not including that. And if it were to pass, depending upon when and what parts of it, it could actually add some upside momentum to the economy. And I don't think it would necessarily add upside momentum to inflation, although there's certainly been a lot of concern, particularly on the Republican side, saying that this would just add to the inflationary fires that are already somewhat burning. But, I'll show you some of these numbers and forecasts in detail, but I think you can see, for this year, this quarter might be a little slower than the 4%, but if it is, we think it'll just come back in the second quarter again as the Omicron affects business activity. But over the course of the year, economic growth of 3.5% to 4% is a pretty good number. And while we have it slowing, maybe closer to trend next year, still pretty good data. But actually, I'm going to ask you to go to the next page so we can look at some of the charts to try to get a better handle and discuss this. So here's GDP. That's the broadest measure. That was the top line, adjusted for inflation. The actual data is out. The data that we're going to get. We don't have the fourth quarter data yet, but we think the number is going to come in pretty well, around maybe 5-6%. And as I mentioned, as we get into this year, we think numbers of around 4%. So clearly, it'll never be that smooth. And as I mentioned, depending upon the variant or other events, you're going to have much more quarter-to-quarter volatility. But we think the underlying trend of some pretty solid growth and tailing off over the course of the next couple of years, but no recession, no outright decline in economic growth that we foresee on at least the 2-year horizon. So I think that's the pretty good news. Going to the next chart, this focuses in on jobs. You can see back in March and April of 2020, we lost 22 million jobs in the economy as we virtually shut it down. Since then, we have created jobs. The economy has created jobs each and every month, although the months of November and December, the growth was a little bit slower, although I think, frankly, it was underestimated. We've been watching a lot of these numbers get revised up a couple months later as more data comes in. But if you look at it over the whole period, we've got about 19 million jobs out of the 22 million back. So we're still shy of the number of people who were working in, let's say, January, February of 2020, although GDP, as I didn't mention to you, but GDP is now back above. In the second half of last year, it went to a new record high, is out ahead, but we've had good productivity, so we haven't seen jobs get there. Our forecast is that by the middle of this year, in another 6 months, we think we'll get those 3 or so million jobs that we're missing, 2.5 million. And we think we'll be there by summer to a new record high. So, maybe 300,000-400,000 jobs a month over the first half of this year. And actually for the full year of 2022, we think we'll get probably 4 million jobs. So as I say, going into record territory. So far, we got 85% back. Let's go to the next chart. This shows the unemployment rate. The top line, it's down to, in December, it fell down to 3.9%. Before the pandemic, it was around 3.5, 3.6. So the unemployment rate has come down, but as I show you below, it certainly hasn't been even in this case, by white, Hispanic, Black, and I don't show you male, female, gender, and it has definitely been harder on women than it has been on men. And that's where some of the labor force that hasn't come back, you hear a lot of talk about that. Again, much more women, much more women of color and older women. And I think a lot of that does have to do with childcare, both in public and private education, is what hasn't come back, especially as kids are in school and out of school. I don't need to tell you there in Chicago about going to school or not going to school. I won't touch that one at all. So we see drops in the unemployment rate. We think we'll be down below 3.5% by the end of this year, basically back down to where we were. But I suspect that won't be that'll be the case for whites. It'll be more the case for 25 to 55-year-old men and women, but not there yet for Black or Hispanics, but moving in the right direction. Everyone talked about the Great Resignation. The blue line is the number of job openings. Dan and I were talking about it. For the last 4 or 5 months, there's over 10 million jobs that businesses say, 10 to 12, or not quite 12, but 11, say, hey, we're looking for people. And, they've been able to find some, but obviously not enough. The orange bar is what you read about. There was a segment on it on 60 Minutes, The Great Resignation, or as Johnny Paycheck sang about it back in, I think it was the mid-1970s, you can take this job and shove it. Now, of course, if you work at PNC, you don't feel that way. We're proud and lucky and fortunate to have such an outstanding employer, and I'm sure for all of you feel the same way. But those other less lucky people are saying, the heck with this. And over 4 million people quit their jobs basically in each of the last 4 months. The data is through November. we've never seen a number like this. And, if you see back just in the middle of the pandemic, not surprising, there were 2 million people. I'm surprised it was even that high back in sort of April and May of 2020 that were quitting jobs. Probably a more normal is a number around 2.5 million. And, we're up over 4. So clearly people, you can be the psychologist about viewing life after the pandemic. You can view, are the wages worth it for you? You can view a lot of those people, by the way, that are quitting jobs are not sitting at home playing video games. They are starting businesses. We have a large number of business and corporations. So I'm sure some people, no doubt, and probably the majority are quitting one job looking for another employer, hopefully better working conditions, more flexible, maybe virtual work as an opportunity, certainly better wages. But a lot of people have gone out on their own. Whatever it is that they want to do, they're starting a new business. And I guess figured this was the time, if not now, when. So a lot of people, and I suspect that'll trail off, but will be well above kind of typical or normal for probably at least the coming year and longer. And the number of job openings are part of the reason we think we will get 4 to 4.5 million new jobs, new people in jobs this year. But even that's only about 1 out of the 3 of the number that are open as of now. I'm going to show you 2 indices. One, these are not from the government, they're from the ISM. In fact, I think it might be headquartered there in Chicago, and they have 2 indices. One is for manufacturing, which, by the way, is about 20 to 25% of the output of the economy, probably only about 12% of the jobs. And the next one I'll show you in a minute is the same sort of index, but for non-manufacturing. But let's focus on manufacturing. We've heard about all the supply chain problems, getting people, getting things produced, getting them shipped, getting distributed, all the supply chains and distribution disruptions. They're all out there, but look at these numbers. Of course, during the pandemic, these numbers fell down into the low 40s. But even just before the pandemic, they were about 50. By the way, 50 is the break even. And this is about 5 or 6 different indices blended together: jobs, orders, inventories, suppliers, prices, the different subcomponents. I'm giving you the kind of weighted average. So right even before the pandemic, it was just barely positive. And look at these numbers. It's rare you see numbers above 60. Yet other than the dip that was for December, the last number there, and that might have a little bit to do with Omicron. I mean, we've seen numbers here that are well above anything you typically saw, even in the last long economic recovery. So despite all the problems manufacturers are having with cost increases and profit margin squeezed and getting materials and getting microchips and getting people, manufacturers are saying, we're pretty optimistic. Our business is very good. And as they say, it trailed off a little in December. I'm not sure I can expect it to be above 60 all year this year. That's rarefied air, but I'm sure we're going to be in the mid to high 50s. And that is a sign that the manufacturing sector, again, 25% at least of the US economy, is doing very, very well. This is the same source, same group, Purchasing Managers Index. Only now who they're asking are non-manufacturers. And this is much broader. They're asking people in the technology industry. They're asking, people in construction industry, in the service, travel, tourism, of course, retailers. This is about 70 to 75% of the economy that are non-manufacturing. This is private, so it doesn't include government. This is private industry. And as I say, this pretty much spans the gamut between retailers, wholesalers, transportation, you name it, and medical care, of course, medical care services. And as you see, dropped off in December to 62, same thing, above 50 is plus. It was before the pandemic started. It fell like The other index did for manufacturing into the low 40s. But look at this. This has been above 60. And even with the latest number, again, wasn't anywhere near this high in, say, 2014, 15, 16. Now, clearly, some of that has come back in the transportation, entertainment, tourism, technology industries. But again, a very solid sign. And again, maybe this number won't stay above 60, but I would not be surprised if it stayed into the high 50s or low 60s throughout the rest of the year. Another sign, again, despite all the supply problems, despite all the labor problems, besides the cost of higher prices, dealing with the virus, non-manufacturing companies are doing quite well. And I expect they will continue to do well. So that, if you got manufacturing and non-manufacturing doing well, and that's basically the whole private sector of the economy, it's why we have pretty solid economic growth this year, even if it tails off a little bit as the year goes on. Just focus in a little bit on a sector that, of course, was reflected in that ISM non-manufacturing, construction. And within there, we're focusing on housing, admittedly non-residential. No one's building too many office buildings, if any, or malls. They're building a lot of warehouse space. So commercial construction is pretty weak. There are some factories being built, and I say lots of warehouses. So I'm focusing more on housing. You can see, of course, housing. This is activity starts and permits collapsed during the pandemic, but it's been on the rise since. And in fact, it's been running higher than the 3 or 4 months. I don't show you way back, but I show you, basically from the fall of 2019 till the pandemic. And we're above that. Now, of course, the lines jiggle around a lot. I try to use sometimes 3-month moving averages to smooth it out. But starts and permits are quite strong. And again, that's despite the problem with finding, labor and supplies and land and building costs and building restrictions. They're all there, yet builders are doing quite well. And our forecast is that, I don't show you there because I just show you data through, in this case, I guess, is December. Well, November. December comes out in a week or so. We think home building will be up again in 2022. So, if you took an average there, it was probably about 1.55 million. That's what that is on the right-hand side, 1.55 million units. We think we'll probably be over 1.6 million units. And if you turn to the next chart, you can see why. This is home sales. Now, the orange line is new home sales. The blue line is existing. We know there's a shortage of inventory. We saw, of course, they held up pretty well. They came down a lot in the pandemic. There was a post-pandemic surge in home buying, and particularly as people were thinking about where they were going to live and work from home. That's trailed off a little bit in the new home. That's the orange line, but we think that's headed back up. And even the blue line, existing home sales, of which there are about 5 to 6 existing homes sold for every new one. That's why the difference on scales, the scale for new home sales is on the right. So that's at about 700,000. At the same time, existing home sales is on the left. That's at about 6.3 million. So obviously that's almost 9 times as many, but normally it's about 5 or 6. And we think new home sales are going to come back up again, and expect that new home sales and existing home sales, even with tight supplies, will be up again in 2022 and into 2023. And again, that's some of the strength in the economy we see. And you go to the next slide to kind of put it all together. And this is home prices. Case-Shiller is a pretty well-known measure of home prices. Well, even during the pandemic, home prices didn't fall. And look what's happened since. As you know, home prices have been up 19-20%. In Chicago, I looked in this Case-Shiller, it wasn't quite that high, but it was in the high teens. And if you went across the major metropolitan areas and even into rural areas, maybe not everything's up close to 20%, but nothing went up probably less than 10%. And, some areas were up 25 or 30. Now, that can't continue either, even with the tight supply of new and existing homes, they become unaffordable in many cases, especially as we'll see in a few minutes. We think interest rates, mortgage rates, and other rates are going to be on the rise. So I expect in the course of 2022 and 23, this is going to, come down a lot. But even if home prices are up 3 or 4%, kind of back where they were pre-pandemic, that's still a pretty good increase. And frankly, is going to make it a bit more affordable, particularly for first-time home buyers. So it's sort of the whole theme of inflation that we talked about. We don't want home prices going up 18 to 20%. That's too much. It's not like it was back in 06 and 07. That was a real literal and figurative house of cards. These are in much better shape. So frankly, less home price inflation and less overall inflation, where we're headed to end this discussion, would be desirable. This brings us to the topic du jour. I know this is a complicated chart, but this is a picture of the inflation rate that the Fed targets, going back to 2012, when they first announced their target was 2%. You see that solid green line, horizontal line along 2% is what the Fed started to say is our numerical objective in 2012. At that point, it was Chairman Bernanke of the Fed. The orange and blue lines, solid ones, show you what actual inflation did year over year, month by month since that time. And as you can see, up until recently, most of the time inflation was below the Fed's target. And indeed, over that whole period, it was about 1.6% for the total and about 1.8 leaving out food and energy. But as they say, look what's happened since. 7 is usually a lucky number, right? You go to the casino, you want to throw 7, at least on your first roll. Well, we had a very unlucky 7 rise in the CPI in 2021. That came out yesterday. I was tweeting about it. We sort of crapped out with number 7 being a CPI. Now, this measure is a little different than CPI. This is the fraternal twin. That's why this one shows it's not quite. The blue line would be the most comparable. It's just shy of 6%. The CPI was 7. The Fed prefers this measure. It does tend to run a little lower. It's probably a bit more accurate over time. But the key is not whether it's 6 or 7. Look what's happened. It just took off in 2021. And the talk of it being transitory that I'm guilty of, along with others, back in the spring and summer, that it's going to be a lot hotter in the spring and summer, but inflation is going to cool off. Didn't happen. Dead wrong. And that's why the Fed has had quite a change of tune over the last couple of months and is going to have a change of policy over the next couple of years. So here's where we are. The Fed's shooting for 2% inflation, and we're at, pick a number. Almost 5 without food and energy, almost 6 with it. As we look forward, we do think we're near a peak. I hope if I draw this chart and show you a year from now, if you invite me back for lucky number 12, although I guess that is craps, but if you invite me back, I hope you'll see these charts have peaked and started to come down, but I doubt they'll be anywhere near 2%. So I think the worst of the momentum on inflation is nearly over. Maybe not quite yet. We may see it still persist into the first quarter of this year, but I think we're going to round that corner. But getting it to slow down is only not even half the battle. The real battle is getting it to slow down back towards 2% and stay there on a sustained basis and not become embedded, as Chair Powell said in his renomination, because he was nominated to be the Fed chair, and I'm sure he'll get that vote. And Lyle Brainerd, the vice chair, I think she'll get that vote. But he talked about, and she talked about, not letting this inflation become entrenched, which is sort of a fancy word for what we used to talk about decades ago. In fact, the only good thing about inflation that I can see is it makes me feel young again. because the last time I talked about inflation, I was probably 35 years old, maybe 40 at most. For the last 30 years, nobody's really talked much about inflation. Well, we had a few moments, as you can see, all during the previous decade, and certainly during the end of the decade, during the financial crisis. Nobody was worried about inflation. They were worried about deflation and lack of job growth. So this makes me feel like I'm 40 years old talking about inflation. But other than that, it really doesn't make anybody else feel any good. And if it makes you feel like you're 30 years younger, good for you. But unfortunately, you got to deal with the reality. So what happens next? Here we get to rates and the Fed. The Fed has already started to taper its quantitative easing. It started that back in the spring of March of 2020, which was the right thing to do. It took interest rates to zero, and it basically flooded the financial markets with money by buying treasury and municipal. I did buy some municipal and mortgage-backed securities. It kept buying the same amount, $120 billion every month until October. And then finally in November, the Fed announced they're going to cut it back, initially by $15 billion a month. Then last month in December, they said, no, we're going to have to get this done even sooner, by $30 billion a month. And that means they'll be done buying bonds by March. And it wouldn't completely surprise me in 2 weeks when they meet at the end of January if they don't say, you know what, we're just going to stop it in February. Or maybe we stopped it in January. So they're done, all but done, buying more bonds. The market doesn't need that. The next thing they do is start to raise rates from the abnormally low zero level that the Fed funds rate, that's the orange line. Not surprisingly, the 10-year bond rate came collapsing down during the pandemic and rose a little last year. It's had a little bit of a start to this year, getting up to about 170 today. We think the Fed probably will raise the rate, if not in March, by May. We think they're going to raise it 4 different times this year. That's sort of what that squiggly little stair-step orange line represents. Rate hikes about, every quarter. By the way, 0.25%, but every calendar quarter. And probably the same thing in 2023. Another 0.25%, 25 basis points in the language, again, about every calendar quarter, which takes you from around 0 to something close to, if not just shy of 2%, not by the end of this year, but by the end of next year. And we think the 10-year Treasury rate probably does finally go up above 2% by maybe the spring of this year and heads towards 2.5%. And mortgage rates, which have been, for a while there, they were below 3%. Now they're in the vicinity of about 3.25%, probably headed up to about 3.5% this spring and even into the 4% range. But that's still a pretty low rate. I still think a lot of people are going to be able to, afford to buy homes. If you got 4 to 4.5 million people getting jobs, you got bigger wage increases, you have inflation slowing down. We think that's a recipe that keeps the housing market fairly solid. So that is our forecast that says the Fed should be more aggressive. That's built into our forecast that the inflation rate will peak. It takes a while for the Fed's policy to impact the economy and inflation. That's one of the first things you learn in economics. Long and variable lags between what the Fed quote does today and when that affects the economy is tomorrow. And the difference between today and tomorrow is not 24 hours in the economic world. It's maybe the difference between today and 6 or even 12 months from now. So frankly, what inflation's doing now is more a reflection of what the Fed was doing a year ago. And they were very, very aggressively easy. What inflation will be doing 6 to 12 months from now will begin to reflect the fact that the Fed stopped or tapered off quantitative easing and started to raise rates, probably in March or April, and kept doing that. And we think, therefore, even in 2023, inflation could get back down towards 2%. But, as you say, that's a couple years away. And it's not going to happen magically. It's going to happen because of what the Fed has to do to make it happen. And they're laser focused on that, especially with the unemployment rate below 4%, with jobs nearly back to where they were, and in our forecast above where they were by the middle of this year, before the pandemic, and continuing to climb higher. Stock market. I haven't said a thing. And by the way, I noticed as I was going through this, some questions about the value of the dollar. So I think Dan, I'll leave it to you to maybe come back to that, because you're right. I didn't have a specific chart in there about the dollar, but here is the S&P 500, the market. I mean, I think that's more representative of the Dow, but of course it's large cap stocks, small cap stocks, have done their own thing. Of course, global stocks, particularly emerging markets, greatly underperformed, although they had a good first week or first couple of days of this year. You look back to basically February and April of last year, look at that drop. As you lived through it, it felt like, at least to me, like you were going broke. You went from 3,300 down to 2,300. It seemed like in an instant. And I was still coming into work or into the office for a little bit of that period. And I can remember every morning the S&P would be locked down limit. Dow would be down 900 points. The S&P would be down 100 points, locked limit. And, it hit bottom. It came back. Clearly, if it had, hadn't been for the vaccinations, it hadn't been for science and our doctors and our frontline people on the front line, both in the medical field and other. And if the Fed hadn't cut interest rates to zero, and if we hadn't had the CARES Act, and if we hadn't had the American Rescue Plan, which was just about a year ago, and other fiscal stimuluses, maybe the consequences inflation today. But if you gave me my choice, if you'd have told me 18 months ago, you can have 7% inflation in 2021, or you can have no inflation in 2021 and have a 12% unemployment rate. And I'm not exactly sure that's the trade-off, but I think we would take the trade-off between having a 4 or 5% unemployment rate and now a little under 4 with inflation. But as I say, that may have been fine, but it can't persist that way. So we think the stock market is going through a correction now. You've seen some dips late last year as the market is adjusting to the Fed's new policy stance. By the way, that was the close as of yesterday. Some of you know it was down 67 points today. So if I updated it, that little line at the very end that sort of ticks up would tick back down, because these are actually day-to-day closes that I've charted there. So, the market 3 or 4 months ago, we all thought the Fed might have to raise rates in the latter part of this year, might have to stop quantitative easing by the middle. It's 3 months later, and everything is sped up. The Fed's stopping QE as soon as this month or next, and they're going to be raising rates, and probably more than we thought, starting either in March or April, and that's going to be persistent. And that's what the stock market is adjusting to, trying to figure out, is that going to kill the economy? Is that taking away the punch bowl, as we used to say, when the party's getting going? A very old phrase. Well, if you're going to get inflation to come down, the Fed has to pursue a different, more aggressive, I won't say tighter, but certainly a lot less accommodative policy. In the past, when interest rates were this low and started to rise, that did not kill the economy. You can see we don't think it's going to. We think it'll slow it down. We don't think it's going to cause a recession. We do think it'll be successful. This is a delicate balancing act to get inflation down without killing the economy. But we think it will work. And as a result, we think any further correction in the stock market, and there may well be further downdrafts, into the mid to even low, 4,000s for the S&P. PNC Investments, or private bank as we call ourselves now, would be buyers. We would be viewing this as a buying opportunity. As you can see, some of those zigs and zags the last couple of years, and ultimately the one back in spring of 2020, although everyone was too scared to do anything then. But we were just trying to tell people back then, don't sell everything. Don't dump all your stocks when the market's 2,300 down a third and live to regret it. So back then it was just try to do no harm by selling everything. Now we've been trying to do some buying. We did some buying late last year when the market dropped down, and particularly in the fall when Delta came along. And now that the markets are adjusting to the Fed and a tighter monetary policy, a rightfully tighter monetary policy, that's some indigestion. And it may well be that the market sells off for the first time close to 10%, which would take it from, somewhere around 4,800 down to 4,300. It's about, 500 points. But we would view that as a buying opportunity because our overall view, to sum it up, is that the economy is still on solid ground. Of course, all dependent on the pandemic, but if we're lucky that Omicron is less serious, at least for the vaccinated, we're going to get more boosters that we're going to see, in particular, even those parts of the economy like travel, tourism, entertainment, dining, do better as we get past Omicron. And the manufacturing sector maybe even benefits a little bit from less supply chain disruptions. And we get more people working and we get better wage increases for a lot of individuals that is above inflation. Last year, wages were up about 4.5%, actually higher, faster for lower income individuals. But like I said, we had the unlucky 7 on inflation. So wages still didn't keep up with inflation. This year and next year, we think wage growth will keep up and probably more than stay ahead of inflation. That puts a little upward pressure on inflation. A lot of it will come from rent. Some of it will come from labor costs. But, we think it's still a better balance to have inflation at 3 or 3.5% and wages at 4 to 4.5%, and maybe even a little higher for some of the lower paid individuals who've seen some of the bigger gains. And in that environment, we still think the stock market is the best place to be. Bonds don't do well when interest rates go up. By definition, bond prices go down. Money market rates, they won't be zero. You might go to your money fund and get 0.5% or 1%, but we'll welcome you to come into PNC and buy maybe a 2-year CD, and we'll pay you maybe 1 or 1.5% sometimes later this year. That's better than what you've been getting. But we don't think even that equals the dividend yield you get on the S&P 500, which is closer to 1.5% to 2%. And what we still think will be a year, not like last year, not 20+%, but a year of maybe high single digit growth in the stock market, and even maybe repeating that in 2022, along with a couple percent for dividends. If you can get somewhere in the high single digits in the equity market, even adjusted for the greater risk and volatility you take, we think that is a much better financial investment than your money in bonds or your money in cash. Although clearly we still advocate a balanced portfolio, 65% stocks, 35% fixed income. So we're not saying throw the bonds out, but we're saying this is not a time to buy a lot of bonds and sell a lot of stocks. We think that is not the right time to do that. So we've gone through a lot of material. Ashley, thank you for advancing all my charts. She's my page turner. And I'm going to stop there, turn it back to Dan. I see a lot of questions coming through. So let me stop my prepared remarks and let's open it up to some Q&A. And thank you for your attention. Happy New Year to everyone. Stay well. And I hope to see you in Chicago sometime in, 2022, 2023, that is. Dan always likes to invite me there in January and February when it's a nice balmy 20 or 30 degrees and wind of 40 to 50 miles an hour. So I'll I'll put up with it if it means I get a chance to be with all of you. Thank you.
Thanks. So Stu, there was a question around your thoughts about international economies. And I guess like you mentioned the dollar, if you wanted to talk to that.
Yeah, I mean, China's been a lot slower, and now they've got problems with with Omicron and who knows whatever else. That's part of the supply chain problem. So it does look like the Chinese economy is going to grow more slowly. But when we look at Europe, maybe Omicron's peaking perhaps in the UK. We'll see. It seems to have been past the peak in South Africa, which might be the leading edge of this particular variant. So we expect Europe to do well, but not grow as rapidly as the US, and that's not atypical. And maybe Northern will grow a little faster, but a lot of that is autos. You got to get some of those microchips into Germany and into the US and other places so they can build some cars. And, a lot of that does come from the Far East, although a number of companies are building fab factories, but that's probably not going to come online until 2023. So we think Europe looks pretty well. Our North American neighbors, we think Canada will do well. They've already been raising rates. They've been out ahead of the Federal Reserve. They realized they had an inflation problem maybe a little sooner than we did. But we think the Canadian economy will do well. Mexican economy maybe not grow quite as strongly. If you go to South Africa or South America, we see some growth there, but again, probably not as rapid as North America. I don't know what to say about Africa, but in terms of Europe, Asia, maybe outside of Asia, growing a bit faster than China. North America doing fairly well, although the U.S. probably outgrowing its northern and southern neighbors. In terms of the dollar, now the dollar's surprised me in this last week. It sold off. We have a forecast out there that we think the dollar is going to get stronger with the Fed raising rates ahead of the ECB. Now the Bank of England raised rates. First, they didn't when everyone thought they would. And then they did when everyone thought they wouldn't. I guess it's kind of like going to a garden party at 10 Downing Street, but no, we won't go there when everyone else is locked down. I guess they just like to do the opposite of what's expected. But in any event, we think the ECB probably will be late to the party of raising the rates. If we outgrow Europe, if we outgrow continental Europe, we outgrow the UK, and we're raising rates as fast, if not faster, over time, that usually supports the dollar. So our call is for a stronger dollar. But I'll admit in the last couple of weeks, but who knows what's going to happen week by week or day by day, the dollar's weakened. But we still think it's headed more towards 110 on the euro. I guess it was down around 111, 112, back up towards 114. We think it could be headed back down into the low 130s against the pound, although I guess it's moved up to around 136. The Canadian dollar, we think the Canadian dollar might get up to about 127, 128. That's Canadian per US, probably a little bit stronger against Mexico. Obviously, it's not going to change against the renminbi because that's pretty much a fixed rate. But yes, we think the dollar against most currencies, whether it's the yen, the pound, the euro, but probably also the Indian rupiah and maybe some of rupee and some of the peso denominated, we think the dollar will be stronger. So it hasn't started out that way, but we think that's a head fake, and that over the course of this year, the dollar is likely to be up 3 or 4%, even though it's maybe down a couple of percent in the first week or so of this year.
Here's another one. Given the inflation forecast, why have long-term rates why aren't they rising faster and real interest rates are still below trend?
That's a hell of a good question. Now, some would say that the Fed has been buying $80 billion of Treasury securities a month up through October, and that certainly, even with the larger deficits, was helping to keep some upward pressure off of the 10-year rate. It has moved up a little bit, as it, of course, is also reflecting an expectation that the Fed funds rate will go up, and the term structure says longer rates are certainly partly dependent upon what shorter maturity rates are. So we do think the 10 years moving up. If you're asking me, why isn't it 4%? Because inflation is 7%, and that would still be negative in real terms. I don't know, but I don't think inflation is going to stay 7%. And my guess is the deficit is actually coming down a bit. A lot of the fiscal thrust is behind us, especially if we don't get the Build Back Better. We don't get another multi-trillion or trillion plus package, even though, of course, that would be spaced out over many years. The infrastructure, 1.2 trillion, is also more of a 10-year package. So the deficit is actually coming down. His tax receipts have done extraordinarily well. And that's been true at the state and local level. I don't know as much in Illinois or Chicago it is in other places. But so we do think the 10 years going up. I did show you the path, the over 2%, maybe towards 2.5%. But if you're going to ask me why it isn't 4 or 5, I got to say, I'm not quite sure I know why, but maybe that's a good sign that it's not 4 or 5. And that's the bond market saying that some of this inflation is going to be transitory, isn't going to stay at 6-7% for the next 5 years, in which case the bond market couldn't stay this low for that long. So it's sort of a bet by the bond market that I'm partly right, and then inflation's peaking and is going to come back down a lot from where it is. And if that doesn't happen, the 10-year rate won't stay below 2% for long, and it may not be below 3% toward the end of this year.
How about oil prices?
So I haven't made a fool enough of myself by trying to predict interest rates, inflation, and the economy. You want me to go full Monty and try to predict oil prices here. I was surprised that they went up. Normally, oil prices in the fall come down. That didn't happen. That's why gasoline got up to $3.50 a gallon, and I'm sure it was a lot higher than that, but the national average is around $3.50 a gallon. Normally, it would be down. It is a bit down. Oil did come off, I think of Brent, because that's sort of the national rather than the WTI. Got up to about $85 a barrel, came down to around $75 a barrel. Wholesale gasoline, you even saw that in some of the PPI report this morning, and a little of it in the CPI yesterday. We did have a decline in gasoline prices at the wholesale and retail level in December. So far, through the first 13 days of the month, gasoline has been steady to down a little bit, but oil started back up. And that's even though OPEC Plus has said they're going to increase production. And Omicron supposedly has, reduced some traveling either by car or something that requires carbon energy to get you there, flying, driving, etc. And yet oil's gone up. I'm surprised. I know Goldman is predicting oil at $100 a barrel. They were predicting 120, then I think they cut it to 100. I'm just not there. Although I know going into the spring, especially if Omicron is less of a problem, oil prices and gasoline prices typically go up in March, April, May, and June, and usually they peak around July 4th, between Memorial Day and July 4th. So if they don't go up, that would be unusual. So I must admit, I don't think they should be this high, but I don't expect that we're going to see any big drop, and could see a run up in oil to into the mid, maybe not 100, but the high 80s or low 90s. And we could see gasoline national average pushing above the 350 or 360 a gallon it was last fall, and then being well above what it was even in the spring of 2021, let alone when it was under $2 a gallon in the middle of the pandemic when no one used it in the spring of 2020. And that's one of the reasons why I don't think inflation can come back down to 2% if gasoline and energy prices are going up and not coming back down into the spring, and then maybe not back down until the latter half of this year. Right.
Well, this is a question that I never thought I'd be asking when we started these 10 years ago, but what are your thoughts on the Fed talking about climate change and getting involved in that?
Yeah, I thought you were going to ask me about Bitcoin, but
I still might.
I was going to say, I think I've already hit the trifecta with oil, stocks, economy, inflation. We might as well keep going. Maybe, I don't know, it's a trifecta. I might as well try to predict the winner of every, what is it if you go out to the track and they have 8 races and you got to pick the winner of every race and then you win gazillions of dollars. Well, I think I'm up to about my 5th or 6th horse right now. So I'll try to run another one, but climate change is obviously a longer term issue. I mean, the Fed is, and Powell's talked about it, and Brainerd even more. And that's probably why she'll get appointed, but will get less votes than Powell will get. Also, Powell is a Republican. Brainerd is a Democrat, so that already goes against her in the Senate. But I think they're talking about it because they're concerned about the risk it could be to the banking industry and the financial system. And, you know, I think they, like all of us, know it's a longer term risk, not quite how to build that into a macroeconomic model, climate change, although others are working on it. So I don't want to say it's all lip service because I don't think it is, but I do think that the Fed is, because of the nature of the Fed and the change in the personnel and the governance by the Congress, thinking about this. And while we're on that topic, by the way, there are 4 vacancies on the Board of Governors. There were 2 vacancies when Biden took over. So that's a year ago. They've been vacant. Clarida just announced his resignation tomorrow, which is only 2 weeks earlier than he was going to leave. And Quarles' term expired at the end of last year. So we actually, after tomorrow, we'll have 3 out of 7 sitting Fed governors. And by the way, 2 presidents had to resign because of questionable stock trade. So we have 2 temporary vice presidents serving as presidents. So there are going to be a lot of new faces sitting around the Fed at the FOMC, which is the 12 Reserve Bank presidents and the up to 7 governors. And I must admit, I think Biden is likely to pick people that will be more sensitive to climate change and diversity and other types of issues that traditionally the Fed was not involved in or didn't think about from their policy point of view. So if they're thinking about climate change and diversity now, I suspect they will get a more diverse group of people sitting around at the table, both by gender and ethnicity and opinions about economics and climate change. And it'll be a much more eclectic Fed probably in 6 months. And we're kind of waiting there who Biden's going to nominate. Sarah Raskin, who was Secretary of the Treasury and the wife of Jamie Raskin, is likely to be nominated to be head of supervision and regulation. But that still leaves 3 more names, 3 more people to be nominated. Obviously have to be confirmed by the Senate. So have to be, hopefully credible picks. But Biden in the next couple months is probably going to announce 4 new names, at least 3, if not all 4, to fill the vacancies that are now, or as of tomorrow, 4 vacancies that will exist on the Board of Governors.
Wow.
So I gave you more than you asked for in that question, but you can predict policy, but sometimes the personalities deciding that policy matter as well. And we're going to have 4 out of 7 new personalities. And of course, Brainerd was on, but not as vice chair. So we're going to have a lot of new faces around that FOMC table, probably before the middle of 2022. We'll have to see who they are in terms of kind of figuring out where their head's at.
Right. Well, in terms of Fed watching, you've done a great job over the years. So that's always good. We have a question about, in general, large cap stocks. on the dividend side, are they generally appearing safe overall? I guess that's more a question on the companies themselves, but.
Yeah, I mean, I'll admit that I'm on the investment policy committee, but I, think more about broader issues of, positioning, not timing the market. I can tell you though, PNC's position is we have certainly seen large cap stocks outperform small and mid cap stocks the last couple of years, although maybe not in the last week. Again, as some of them have been, the high flying, high tech stocks have been hard hit, although we wouldn't have owned a bunch of them anyway. I don't think we would have owned too much of some of these EV auto companies, maybe other than Tesla. And we probably didn't own, we're known a number of the really kind of, stocks that have their PE ratios are even above my age. That's how high they are. They have PE of 72. And some of them have, I think some of them have PEs that were even older than Moses and Abraham, who lived to 300 or 400, as I recall. So, and we have some that don't have PEs because there ain't no E, and you can't divide by an undefined number. So some of those stocks, I don't think we would have been buying anyways. But we still like large cap. Small caps have become cheaper relative to large cap. Frankly, international on a PE basis, particularly emerging markets, look cheap relative to domestic. And we have staked out a position, for our clients, if they're going with our recommendations, to have some money in international stocks. Didn't work quite that well last year, but we're still there. We don't think we're overweighted, but that means we still like large cap, domestic, and an international. And we still like some emerging market stocks, but admittedly, up until the last week, that hasn't been a big winning strategy. But as you said, of course, then you get into company by company, and they only do as well as the company. And I'm not an individual
Right.
Company analyst, but we got lots of people around PNC that could give you a better answer to that question and give you specific large cap stocks that we are holding and adding to in our clients' portfolios.
So while I have the chance to keep putting you on the spot, what is the biggest risk that you see, a downside risk in your forecast for the economy?
I mean, the virus, going a new strain that is got all the bad features of Delta, Omicron, the original COVID strain, whatever we called that. I don't know if it had a Greek name or maybe that was Alpha. And that's always the top number one risk because of the health implications, the supply chain disruptions. It would add to the inflationary pressures. But even if that's not number one, number two is inflation. Even with more supply chain improvement, if we see a much higher push in wages, we don't see worker productivity. Of course, we see that at PNC and where you guys work, but at those other slouchy people working, those other derelicts working and lazy, good for nothings working at other companies don't do their part. You don't get productivity, you get more inflation. And you mentioned about oil. Hey, if oil ends up at $100+ a barrel in the spring, 100, 110, and it's more again because OPEC won't produce enough oil. They won't up their supply, which really gets back to Saudi Arabia. That's another big risk to the upside for inflation. And while it might be good for oil stocks, it wouldn't be good for the overall global economy, the U.S. economy, and it wouldn't be good for inflation. So I guess I'd argue OPEC not meeting the rising demand for oil, inflation becoming a wage price spiral, and of course, COVID continuing to morph into new strains that are deadlier and are continue to keep our kids out of school in Chicago and every place else and keep Dan and I out of our offices and, keep us all from being together next year at this time and enjoying one another's company. Those are my downside risks. And there's and certainly the oil, the virus are global in nature. And of course, the Fed making a mistake by either jacking rates up too fast and killing the economy, or maybe a mistake some say they've already made. They should have already been raising rates and they've been derelict. And now they've sort of got to run at double the speed to catch up for lost time. But that's a good way to say they overdo it in the near term. So those are Fed policy risks and global and obviously pandemic, all downside risks to our forecast.
I know we've had you talking for a while here. Let's go with one more question and kind of get an update. I know we've talked about this over the years, but especially with all the additional money we've been printing lately through COVID and all the relief packages, what are your thoughts about becoming too dependent on China and Russia for some of that, funding our operations?
Russia is not funding any of our operations. I mean, as I said, the Fed has basically bought the debt over the last couple of years with its quantitative easing, its bond buying. But we were in a war. I still think of it. Sometimes I'll revert back to the war analogy. We were and are still in a war against COVID. And wars are expensive. And it was a global war. And we spent a lot of money. And that gets back to my reference about, would you rather have 7% inflation and 4% unemployment, or would you rather have, 3% inflation and 14% unemployment, although I've exaggerated the extremes there. We also saw after World War II a burst of inflation. We saw after the Vietnam War a burst of inflation in the early 70s. We even saw a relative burst of inflation in the mid 50s after the Korean War. So fighting wars are expensive. In this case, a medical war rather than a shooting war, so to speak. And maybe some of this inflation is the consequence of having to buy all that debt. But we bought it. The Chinese didn't buy it. The Japanese didn't buy it. The Russians didn't buy it. We, meaning private pension funds and individuals, and obviously our Federal Reserve, our central bank, bought trillions of dollars. That's how its balance sheet went from 4.5 trillion to 3.5 pre-pandemic and more than doubled. A lot of that is the debt that the U.S. Treasury issued over the last 2 years. So the economy, in my opinion, didn't probably collapse into a depression. So the real issue is going forward, the Fed's not going to be buying that debt. The Treasury won't be issuing as much, especially if we don't have a Build Back Better and we have recovery and better tax revenues and less unemployment compensation, et cetera. And the private sector in the U.S. and around the world will buy it. And that's part of the reason we have interest rates going up, that there's going to be still a lot of Treasury debt, a lot of private corporate debt. They're not going to have the Fed, the big gorilla, buying all that debt. And so rates are going to have to go up somewhat, back closer to normal, to get private investors to buy that debt when the Fed steps away, which is, it's all but done that, or will do that probably by March at the latest.
I think we hit on most of them. So I do appreciate it, Stu. We will be able to distribute the presentation to all the attendees, correct, Susan? So
yes, absolutely.
We'll get that out.
Correct.
And then, again, I'd like to thank Stu and remind everybody about for all the guests, about the trial membership that we have out there. If you have any questions, please feel free to reach out. And then keep an eye on our newsletter and the website. We have some great programs coming up with our career management group meeting in early February to talk about your career reboot. So We appreciate it. We'd like to thank all of our sponsors for being part of FEI and continuing with us. So with that, thanks again, Stu, and thanks everyone for attending, and have a great evening.
Stay well. Thank you.